Happy Monday, everybody. I hope you had a great weekend. Today is September 15th, 2025, and this is your Monday market update. Now, markets ended last week at fresh record highs. AI optimism collided with inflation data and a softening labor market. The week gave us everything: geopolitical flare ups, eye catching corporate earnings, and inflation numbers that were good enough to keep the Fed on track for rate cuts. So let's walk through it all day by day. The new week started on a cautious but steady note. Stocks opened higher as bond markets continue their rally, reflecting growing confidence that the Fed will cut rates at this week's meeting. Overseas, weak export data out of both Germany and China added to global growth worries, but the softness in yields did provide a cushion for equities. By midday, sentiment wavered a little bit on signs of consumer strain. A report showed consumer credit jumped 16 billion in August, well above estimates, suggesting households are leaning more on debt to maintain spending. I think we know that already. At the same time, a New York Fed survey highlighted rising one-year inflation expectations and the lowest probability of finding a new job since 2013. Those stagflation concerns briefly weighed on stocks, but support held near 6,500 on the S&P. By the close, a rebound left the markets modestly higher. The Dow up 0.25%, S&P 500 up 0.25%, and the Nasdaq up 1/3%. Cautious trading carried into Tuesday. Markets opened modestly in the green, but faded as stagflation worries lingered. Investors are watching inflation and growing data in tandem, because if both deteriorate, the dreaded stagflation narrative could return in force. Later in the session, the bigger than expected rise in consumer credit did reinforce concerns about the household balance sheet. That, paired with weaker export numbers overseas, left equities drifting sideways. Still, underlying Fed cut optimism kept the floor under stocks. The S&P 500 again held firm around 6,500, reminding us that investors are willing to buy the dips as long as inflation doesn't surprise to the upside. The Dow was up 0.25%, S&P up 0.25% also, and the Nasdaq was up 1/3%. Wednesday gave us fireworks. Pre-market news broke of Israeli strike on Hamas, leadership in Doha, Qatar, raising geopolitical concerns. Then the Bureau of Labor Statistics dropped a bombshell: a downward revision of 911,000 jobs to payrolls as of March, meaning the labor market was weaker all along. Instead of sparking rate cut optimism, the revisions created some hawkish money flows in bonds and currency. The reasoning: if the labor market wasn't strong to begin with, the Fed may not need to slash rates aggressively. So the yields popped up. Stocks fell to their low of the day near 64.80 on the S&P, dropped below that 6,500 number. Then the narrative flipped. NVIDIA unveiled a new AI chip system for video and software development, stabilizing the tech stocks. And of course, we know what that does. Treasury Secretary Bessent added dovish fuel, warning about the Fed choking off growth. A strong 3-year Treasury auction reinforced demand for bonds, calming markets. From there, equities ground higher into the close, finishing at new records. The Dow was up almost 0.5%, S&P up 1/4%, and the Nasdaq was up just under 0.5%. Thursday belonged to Oracle. The company's earnings looked soft at first, but one metric shocked Wall Street: remaining performance obligation. That's RPO. That one's a new one, new term for cloud. That's backlog. Jumped 455 billion year over year. That's a 359% surge. Shares rocketed as much as 43% intraday before closing up 36%. That's extraordinary for a company of Oracle's size. That single earnings line reignited AI optimism across the market. Semiconductors, networking, and industrial metals all benefited from the AI spending as stimulus narrative. We even got some of the energy market moving on that demand report. Meanwhile, inflation helped the story. Producer price index fell month over month, far cooler than expected, easing concerns of a renewed inflation flare. With both AI and inflation tailwinds in play, stocks opened strong after hitting fresh highs. Profit-taking set in. Traders booked gains, and the markets drifted sideways into the close. The Dow was down nearly 0.5%, the S&P up 1/3%, and the Nasdaq was up 0.5%. Friday capped the week with a bang. The consumer price index came in hotter than on the headline, as expected, more than expected, but the core CPI held steady at 3.1%, exactly as forecast. Market interpreted that as good enough. No upside surprise to derail the Fed cuts. At the same time, jobless claims jumped to 263,000, the highest in 4 years. Normally, rising layoffs would spook investors, but in this environment, weak labor data was seen as reinforcing the case for rate relief. Stocks steadily climbed throughout the day, closing near session highs. By the bell, the S&P 500 was flirting with 6,600, marking another record. The Dow was up almost 1.5%, S&P up nearly 1%, and the Nasdaq was up just under 1%. For the week, the Dow was up 1.7%, S&P S&P up 1.5%, and the NASDAQ was up 2.25%. It was a week defined by three themes. AI remains a powerful driver. Oracle's backlog explosion underscored just how much money big tech is pouring into AI infrastructure, from semiconductors to cloud capacity. Inflation data was good enough. PPI cooled more than expected. CPI wasn't worse than feared. That left the Fed on track to cut rates by at least 75 basis points by year end. That's many people's opinions. Labor cracks are spreading. Payroll revisions and jobless claims both pointed to weaker job market. For now, investors view it as a reason for more Fed support. But if deterioration deepens, markets will need to reckon with growth risks. This week, we're back to Fed Watch. The Federal Reserve takes center stage. On Wednesday, the Fed's expected to cut interest rates by 25 basis points. The real market driver will not be that. It will be what Powell's tone is in both the written statement, but more so in the press conference. Is this the start of a broader easing cycle, or is this a one-and-done insurance cut? Other key catalysts include tomorrow, we're going to get August retail sales. That, again, is a vital check on consumer spending. About that, fun fact, U.S. consumption is top-heavy. The top 40% of earners drive more than 60% of spending. And a recent Federal Reserve paper showed that the resilience of the U.S. consumer since 2021 is thanks to those earning over $100,000 a year. Wednesday, as I mentioned, the Fed decision, dot plot, and Powell's press conference. Expect volatility. The SEP 2, in case that's a new one, the summary of economic projections. Thursday, we're going to get housing starts and permits, another lens on growth momentum, jobless claims too, and this, of course, will matter, as I mentioned, since the Fed is watching the labor market so closely. We'll also get some earnings. FedEx is going to be a good read on economic activity. General Mills and Adobe, they will all headline. Shipping, consumer staples, and enterprise software all going to provide valuable clues on the economy's health. Also on deck, Meta's Connect event, where the company will spotlight AI and augmented reality technology, another potential spark for tech sentiment. Now, before you go riding off into the week, let me set the stage with a few facts to ponder. First, from LPL Research. In line with the video from a few weeks ago about not getting stuck on the too high thoughts, the S&P 500 has climbed over 30% since April and now sits 5% above its post-correction recovery level on June 27. After a 10 to 20% corrections like we saw in April, double-digit returns for stocks over the following year are common and declines are quite rare. And one more micro fact about the AI spend, in case you're wondering where all the money will come from, you're not alone. OpenAI, the company behind ChatGPT, reported that they now expect to burn $115 billion between now and 2029. Not to worry, that will be $13 billion. That will be on $13 billion in revenue this year and $200 billion in revenue by 2029. Just to put that into perspective, how much is $115 billion in terms we can use? The company Intel is worth $114 billion. And that's one versus 115. Amazon and Meta will each spend $116 billion on CapEx this year. Now, the last 34 quarters of Walmart profit was $117 billion. That's 34 quarters is equal to just a hair over what they're going to burn through in cash. And finally, Apple's total current assets are about $122 billion. Yes, these numbers are big, to say the least. It should play into your planning. So let's discuss. So now that we have the recap of last week and the preview of the Fed week, you can go into the week ready for things. As we talk about all the time, this is the details. Your goals in almost all cases will not change based on what happens this week, no matter what. We still have the wild cards. Last week we had the loss of a major political figure, and much more and much more. We'll see what this week has in store for us. Have a great week. Keep in touch, keep planning, and stay in touch.